What is love? Baby, don't hurt me. Don't hurt me no more.
Just getting started here. I'm gonna check if the stream's online. All right. Okay, I do not want a copyright strike, so I'm gonna turn that off. But I just thought, the last time I was talking on this subject, the episode was titled, What is Vol? I did that last Friday. And, vol and love are very similar. Just gotta reverse the letters and put an E at the end. One quick thought that I had on that subject is that evolution, evolve. I wonder if that has a similar etymological root to volatility, because it's certainly related. But nevertheless, let's dive in. So today I'm going to be reacting to the second part of Mike Green and Chris Cole. These are two of some of the smartest people in finance. And it's a very interesting conversation. They were talking about some historical events that happened during COVID and how volatility spiked and then went back down. And they were talking about some of the underlying factors that caused that. And I'm not a finance guy. But I think this is a really important subject to talk about, because understanding volatility gives you an important lens through which you can look at all kinds of systems. Any sort of complex system, it's very important to understand volatility as a component when you're analyzing these systems. So, for example, we were talking about AI and how that's a complex system in past streams. And we're going to be talking a lot more about different types of markets and adversarial environments for cryptographic protocols and stuff like that. And we're going to take this framework of understanding volatility, and we're going to apply it to all these other domains in future streams. But the people who study volatility in a sense, in one of the most understandable and relatable ways, are finance people. I think physicists also have models of volatility, and I think a lot of that is very technical, and you need to have a lot of specific knowledge about specific. You need to know a lot of physics fundamentals before you can really start to grasp those concepts. And that's not something that I personally have training in. So I'm not equipped to go down that road, although it is a very interesting field. But finance is a great entry point, because also along the way, you're going to learn so much interesting things about what's going on in markets, what's going on in the economy, and how the world actually works. So in order to really understand volatility, this is something I'm continuously learning as well, and you're just coming along this journey with me. But we're going to be listening to a series of videos by Chris Cole and Mike Green, and we're going to dive into a lot of the things that they say. And this is just the first one. I would say that so far, the conversation has been interesting, but it's been a little bit technical for people like me. I'm not a finance bro. I don't know all the details about financial markets. I'm an entrepreneur and venture-backed founder and engineer. I work in crypto. So it's been a little bit technical. It's gotten into the weeds of some historical details. It hasn't been super high level, but I think the second half of this conversation is likely to be a bit more high level, and we might get a few more takeaways than we would have in the previous episode. Although I do recommend going back and watching that, because I think it was still very entertaining and interesting. And as we go down this path, there's another great interview that I had listened to more recently between Mike Green and Chris Cole. And so I'm going to, after this, on a different day, I'm going to be going to that other, reacting to that other video, so we can get that context. And I'm in the process of studying all of the different papers that Chris Cole has published, all the different memos that he's put out for his hedge fund, Artemis Capital. So I will at some point give you a synopsis of that, but it takes a little bit of time to get through all of them. And so let me share my screen really quickly. And we're going to be back where we started here. And yeah, this is if you see over here on the side, this is going to be one that we're going to react to a bit later. And one final thing I will mention is that you can find this video. Go ahead and search this. You can watch the whole video without my commentary if you like. But another way is to you can go on my channel, and there is a sources playlist, and it has all the sources to all the major videos that I do reactions to. And so before we dive in, I just want to make one more comment. And I want to say that I make videos about the intersection of technology and society. So I talk about AI, I talk about crypto, I talk about anything within the tech industry, anything that has to do with advancement and progress. And I talk about the implications that this has on politics and society. And I talk about the big ideas. So for example, I've talked about, will AI kill us all? I've talked about how crypto and AI intersect and what type of lessons you can learn from studying these types of systems, how you can, how that affects political philosophy and all that kind of stuff. So if you like these types of high level, intellectually stimulating, thought provoking, technical pieces of content that get into the details, you learn things, but also, you're not having to sit there and take notes. It's entertaining. It can be funny at times. If that's the type of stuff that you like, I do hour-plus live streams every single day, so you'll never run out of content if you subscribe to me. So please, if you're watching this, subscribe, hit the like button, and comment any thoughts that you have. I love getting comments. I'm very early in my YouTube journey, and so I greatly appreciate anyone who engages. All right, so now let's get into the reaction.
I sadly put it off because now it feels so outdated. But we looked at 150 years of what would the average corporate pension system return over 150 years if you excluded the tremendous period for stocks and bonds of the last 40 years. And the average return drops all the way down to about 5%. So, I mean, in this dynamic, if they keep borrowing yields so low, these pension systems and retirees are not, of course, we are not able to meet these 7.5% actuarial return targets. So at these current levels, you could expect, going forward, if we have a kind of average return on bonds and stocks, about at a 5% kind of level for the composite pension portfolio. The 70-30 pension portfolio will return about 5%. Then about 1/3 of the state and local pension systems will be insolvent.
Okay, so I want to provide a little bit of context here, because I do recognize that we're jumping it back into the middle of this conversation and you may not have the full context. So essentially what Chris Cole was saying is that we have two types of possible bad outcomes that could occur. One is a corporate solvency crisis, meaning that a lot of corporations are levered up. They have a lot of debt, and as a result of this debt, there could be, if, for example, there's a liquidity crisis, this could trigger a solvency crisis, meaning if they don't have enough cash and liquid assets, they may not be able to service their debts. And since they're so levered up, what this would mean is this could cause a cascade that would crash the market and cause lots of companies to go insolvent. This would be a very catastrophic thing. So the problem this is likely to happen, for example, if interest rates rise and it just becomes very expensive to service debt. However, let's say that we were somehow able to avoid this corporate solvency crisis. What would then happen potentially is there would be a pension solvency crisis. And so maybe the corporations are fine, but that now the pensions are unable to fulfill their obligations. And so he's just talking a bit about the reasons for why that is. I think I want to back that up just so that we are getting this full thought and his full justification. And I also, I just like to pause here before we dive in. I do want to also kind of go off on this little tangent. It's really interesting talking to people about politics and economic policy. And a lot of left-wing people who are very sympathetic to labor and don't like corporations and don't like, you know, just this like free markets and whatnot, they will often have some sort of policy proposal. And it could be anything. It's usually something that hurts corporations, you know, maybe hurts the stock market, hurts the finance industry. And I think a lot of these people are coming from a good place. They have genuine concerns, and they see what they perceive to be greed, or they see some sort of corruption in the system, and they blame the financiers, and who are honestly, to a large extent, complicit in systemic problems in our system. And we're going to talk about this in later episodes. But what they often miss is that the system is very interconnected and entangled. So, for example, if you crashed the stock market, if you had some sort of sweeping economic policy that you know, destroyed the capital markets and crushed corporations and did all these things, you think you're getting back at Wall Street, and you are making Wall Street have a hard time, but you're also affecting a lot of other institutions, such as pensions. And this is like for, you know, government workers and unions and nurses and firefighters and teachers and whatever, right? All of these people that you want to help, typically you're super sympathetic to, they are highly invested and dependent on the system continuing along with the status quo. So what you have to realize is that if you mess with it, you, like, in a sense, there really is this dilemma. If you want to go aggressively from a policy perspective after corporate profits, you're going to end up crushing pensions. And that's going to be bad for unions, and that's going to be bad for labor. And you're going to also hurt a lot of people's retirements and a lot of other things. And so this is a very important thing to keep in mind, just in general. But let's go back just a few minutes to hear him start talking about this issue, and we can let him give his justification for it. Okay, let's see. When did he start talking about this?
Actually, you're contracting.
Here
we go.
Next point, and a beautiful segue into this next point, because on one scenario, let's imagine that they're able to engineer inflation.
Yep.
Well, I go take a step back. What they did is to solve a liquidity problem, they've created an even bigger corporate solvency problem. The corporate solvency problem was at all-time highs prior to COVID. So it's not like COVID, it's not like a one-time thing with COVID. This was a problem pre-COVID. It's gotten even bigger and more massive post-COVID. Well, we're still going through COVID. Well, so let's imagine I'm agnostic to whether or not rates stay low or whether they go high. I don't know. Let's just say I don't know. I don't have an opinion. But let's say they succeed in their ability to engineer inflation. And as a result of that, we get a renormalization of rates. Rates go back, not massively, we're not talking hyperinflation type of stuff or 1970s stuff. They go back to where they were at their corporate rates go back to where they were throughout most of existence. And that's about kind of where they were in the mid to late 90s. Under that scenario, just based on a simple back of the envelope calculation, the rising interest payments will force net profits to drop by 1/3. Corporate profits will drop 1/3 if rates go back and corporate borrowing rates go back where they were in the late 2000s. That's not including the number of kind of zombie companies that will just go bankrupt because they're not able to. That's just a simple back of the envelope calculation, assuming that you pay the higher interest rates. It's not assuming the number of companies that would go bankrupt because they won't be able to borrow. They won't be able to roll over the debt. Let's imagine rates go back to where they were in the 70s. Corporate borrowing rates go back to where they were in the 70s. It would be
you're actually, to be more dramatic about this, right? You're actually referring to the debt service associated primarily with the interest expense.
Yes.
We're not talking about the cash flow characteristics of your inability to refinance at the higher interest rates because of the deterioration in corporate credit quality that would imply, right?
Yep.
The lower servicing of EBITDA to interest payments, for example.
Like, as dramatic as this is, it's actually kind of a best case scenario because it does do
right,
because people are unable to hold it. Just pay more to service
right.
that.
And the increase in part, unfortunately, what that creates is conditions under which we understand the collateral that credit represents in the system, whether we think about it in the IG space or we think about it in the high yield space. That is somebody's asset, right? And what you're describing are the conditions under which that asset falls in value going forward, which reduces the borrowing capacity of the overall system as well. This is my primary concern with the way that we have set up the system. I forget who it was actually highlighting this, and I thought it was actually a really, really good observation that the system has moved from one that is predicated on the idea of fractional reserve banking, where the banks are the source of leverage. And increasingly, we've moved to the shadow banks, where collateral at the core of lending, the ability to lever a portfolio by posting collateral is kind of the core of what allows us to expand or contract our credit at this point. And as we move from a low interest rate environment to a high interest rate environment, by definition, we actually are contracting that collateral. As a bond matures towards par or a bond matures toward risk of default finance, collateral in the system falls, and the Fed is forced to
You run into a liquidity problem
Correct.
because everyone's holding 7-year duration treasuries and rates go up 100 basis points, all of a sudden you have about 1/10 less
Collateral, correct.
collateral. Yeah. So, to explain that concept. So it is on the flip side of it, what's interesting, despite this extreme corporate GDP, and it truly is extreme by any measure of history, and it's also replicated by the fact that, borrowing levels to GDP are at the highest level that they've ever been. U.S. Treasury borrowing levels to GDP, the deficit's at the highest level it's ever been, except for World War II. That's the other aspect. It's not just corporate borrowing. But oddly, right now, the corporate bond market is so complacent because they've kept rates down low, they backstopped it. And as long as rates stay where they are, there's not a problem with the interest rate payments for corporate America. But there's a separate solvency problem that's introduced. If they're successful on the other leg of it, in simply capping rates, they're able to simply cap rates, suddenly you've got a pension solvency problem.
So just pausing it here, I normally pause it more often and dissect and give commentary on that. I thought that was such a good segment, though. It's nice to just hear that uninterrupted. But if you do want my commentary on that, you can go to the last video and see what I was saying last time. But yeah, that was great. I just wanted to give you that as the context for this video. And I also, as someone who was, doing the stream last time, it was nice to hear that refresher of what they were talking about in that segment. So I don't think it was a waste of time for anybody to listen to that. But yeah, I just wanted to give you that context. Now let's continue diving into the specifics of this pension solvency problem that they're talking about.
This is a piece of research I never got a chance to publish. I might publish it at some point. I sadly put it off because now it feels so outdated. But we looked at 150 years of what would the average corporate pension system return over 150 years if you excluded the tremendous period for stocks and bonds of the last 40 years. And the average return drops all the way down to about 5%. So, I mean, in this dynamic, if they keep borrowing yields so low.
One second, I just want to hear exactly what he said one more time.
Outdated. But we looked at 150 years of what would the average corporate pension system return over 150 years if you excluded the tremendous period for stocks and bonds of the last 40 years.
So he's saying that most of the gains are in the last 40 years. And so when you look at the returns, you think that these returns are good, but actually they're quite low if you just exclude this 1 year, this one segment of 40 years. Now, I want to hear why he thinks that what this has to do with interest rates rising, or sorry, no, with interest rates falling, and how that creates a pension crisis. So just to be clear, he's saying if interest rates go up, it's going to cause huge problems in corporate America because they're going to have to service the debt. They're not going to be able to. They're not going to be able to refinance. They're going to have all this money go to debt payments, and there's going to be they're going to default, and there's just going to be a lot of systemic issues that are downstream from that. That's what happens if interest rates are high. And the problem is they have a bunch of collateralized assets. And so those assets are put up as collateral, and there's loans against them. And then basically that collateral is going to get repossessed when they can't service their debt. And this is just going to cause a lot of issues. So if you keep interest rates low, though, you make it easy for them to to pay the debt that they already have. You won't trigger this type of a corporate solvency crisis, but somehow this is going to make the growth rate for pensions lower. He's going to explain this more, so let's hear what he has to say. I'm not fully sure exactly why that would be based on what he's saying so far. Perhaps you could argue that in the past 40 years, we have decreased interest rates from very high levels, steadily decreased them down to basically zero in like 2010 something. I don't know when it was zero, but whatever, like 10 years ago. And we've increased it a little bit ever since then, but it went basically from very high, record high amounts down to zero. And this does stimulate growth. So perhaps all these great returns that we're assuming with the way that pensions are structured is based off of financial models that are incorporating the returns in the past 40 years, which has been in an artificial environment of lowering rates, which you cannot do indefinitely. I mean, you technically can go negative, but there is some limit. Zero is a pretty good limit, but perhaps you could also have like some negative limit, but you're not going to be going down to negative 100%, for example. So there is like a floor to which you can decrease things, and then you no longer have that stimulus as an option. So if you started off really high interest rates, and you just slowly were decreasing it over time, you have like, that's like how much ammunition you have to stimulate the economy. And once you've depleted it to the minimum, now you don't have very much. So maybe that's what he's going to say. Maybe that's not. Let's see what he has to actually say about this.
And the average return drops all the way down to about 5%. So, I mean, in this dynamic, if they keep borrowing yields so low, these pension systems and retirees are now, of course, able to meet these 7.5% actuarial return targets. So at these current levels, you could expect, going forward, if we have a kind of average return on bonds and stocks, about at a 5% kind of level for the composite pension portfolio. The 70-30 pension portfolio will return about 5%.
Yeah, and it's important that to note that the maybe it's not necessarily something fundamental about pensions in general that couldn't have high returns, but the way that pensions are structured is based off of quantitative analysis of our economy and financial markets. And so then they do these 70-30 portfolios. They are doing that because they expect a certain return profile. And what he's implying is that the return profile that you get from doing this analysis is anomalous. And if it reverts to the normal return profile, it's going to be a 5% return instead of a 7-point-something% return. Let's just say 7% return. And so the issue is that pensions have a pretty good sense of their obligation. They need to pay out certain monthly payments to people over the course of their life, which they have actuarial tables for. So they have this really good, solid understanding of what their obligations are going to be. But if they are, they're choosing their portfolio in part based on a return that's needed to hit their target in order to meet their obligations. But if that model is wrong and it's actually going to make substantially less returns, then they picked the wrong model and they're screwed. And maybe this is something where a better portfolio manager could have prevented this. That's not really relevant. It doesn't matter what pensions could do. Are pensions theoretically insolvent? Like, is there no way to run a pension? I would not argue that, but let's just look at what pensions that exist today that tons of people are dependent on. How are they structured? What are their portfolios looking like? That's why this is super relevant. But anyway, let's continue listening to what he has to say.
And about 1/3 of the state and local pension systems would be insolvent. And by insolvent, I mean, actually, technically, over 50% would be insolvent, because over 50% would be under the 50% funding ratio. 1/3 of those would be under 33% funding ratio. And that's just state pension systems. So, people are up in arms because $85 billion was applied in the latest stimulus bill to union pension bailouts. $85 billion, and people are really upset about that. Some people are. Some people are really happy about it, but some of the right-leaning people are very upset about that. I'm not in a political argument here, but to put this in perspective, the state pension deficits, if rates stay low, would expand from $1.4 trillion under that scenario to approximately $4 trillion. If we had a repeat of Japan, those pension deficits would expand to $9 trillion. I mean, if you think about,
that's a lot of money. Yeah.
It's a lot of money. That's a lot of bailout. Yeah. So they're kind of in this, they have to keep things.
So when he says deficit, what I'm assuming that he means is their inability to meet their obligations. So they have some returns. I'm not saying, he's not saying they're going to make no money. They're not going to grow. Basically, a pension is a pool of investments that have been contributed to through some organization as in the goal of providing retirement income. So there's, assets that come in, there's a continuous stream, presumably, of assets coming in, and they are invested and grown so that there may be some 20-year-old employee when that person is 65 or whatever, 45 years later, that amount that was contributed back then has grown a lot and compounded. And now there's a lot more to give that person. And so then they can kind of have this payment that they can expect on a monthly basis. And in a sense, it's kind of nice to have a pension for peace of mind, because you don't have to manage your own investments. This is a fund where they're going to basically pay it out for you. I think people like Dave Ramsey, they actually don't think that pensions are usually a very good deal. They usually say you're better off, investing the money yourself rather than going through a pension system. So if you have the option to be bought out from your pension, they recommend doing that. But that's all beside the point. What is important is that basically they have an obligation, and then they have, income, I guess you could call it. And if their obligation is higher than their income, that's what I think they're referring to as a deficit. So what it seems like he's saying is that if their deficit would rise by trillions of dollars under the scenarios of reverting to the mean return on this 70-30 portfolio. If you go back, go back and exclude the last 40 years. And basically what that means is, especially for government pensions, where it's essentially owed to people, maybe it's not technically like a debt, but it is considered as an obligation that's owed. That's a taxpayer funded bailout, essentially. And perhaps even, people are very sympathetic to pensioners, so perhaps even private sector pensions, which are less and less, they don't exist as much these days, but like union, for example, union pensions, all of these groups who don't have government pensions, he wasn't even talking about them. They're also are at significant risk. And I mean, would the government bail them out? I don't know. They bailed out Wall Street in the past, so maybe they would. But anyway, this becomes like a huge set of a huge mismatch in what they have to pay out versus what they have. And I think the 9 trillion number, and I don't know, that's not 1 year. So like, what is that? That's like over the course of 10 years or something, or is that like the total amount over the lifetime of a person? I don't even know what that number is. But I mean, 9 trillion is a big number. I mean, our GDP is what, like 30 trillion? I honestly have no idea what the GDP of the US is. But with all that aside, that's a huge percent of GDP. So that's huge, a huge bailout. And Japan has had really slow, grueling growth over the past decades. So if we went to Japanese levels, not just the historical mean excluding the past 40 years, we would be even in an even worse situation. And honestly, you can't count that out as a possibility. So let's keep watching.
Is in this narrow band, or else you get an ungluing of the system. If you end up keeping rates too low, expect more pension bailouts coming.
Yep.
Which will cause massive problems with fiscal deficits, which will cause which will be inflationary in its own right with respect to money and spending.
One other thing that I will say about one reason why interest rates, low interest rates, also could be bad for pensions, which they're not saying here, but I'm just kind of trying to think through it. And this is probably maybe the first thing that came to your mind. I had also thought about it, but I didn't say it. It's just the fact that, if you hold bonds and the yield of these bonds is lower, that is just worse returns, just straight up. Now, if you think the interest rate is going to decrease, that can still be a good investment, because that's going to be a great video. I want to talk about the discount rate and how bonds work. It's a very important concept to understand. I will do that one day. But if interest rates are lower, the present value of a bond, even if the interest rate seems pretty low, goes up. And that could be a very good investment. So if you know what interest rates are going to do, you can make a good investment, but it's like a two-pronged thing. They're buying bonds, and the interest rates are, if interest rates are low, they're buying bonds, and now they can't really continue decreasing interest rates past a certain point. So there's like a floor. You can't stimulate their value in that way. And also just the nominal returns that you're getting from those bonds are also low. That I think is definitely part of it. And I think that's probably what he's talking about. But I wonder if he'll go more into detail, or I also I want to say, like, this guy, he knows his stuff, like he's very credible. So I do, even though he hasn't fully explained it, as far as I can tell, I will just take this analysis on face value, because I think he knows his stuff. So let's keep watching.
On a fiscal level, if you let rates go high and you push rates too high and they get out of control, you've got a massive corporate solvency problem on your hands. So either way, that spread between OAS, corporate credit spreads, Treasury vol, and an S&P vol should narrow in either direction. I would actually think that credit spread should increase, is what I would expect to see. But that's how it relates to that.
You would expect them to increase, you're saying?
I would expect an increase, because I think we will face a Minsky moment where, given the framework towards populism and given the political winds and this political dynamic where we're moving from a dynamic of lower regulation and less taxation to more income redistribution. I'm not making an argument for either. I'm just saying I'm expecting us to move from this. It's going to be very, very hard for monetary policy to continue to support corporate bond market over the middle class.
Well, I would also suggest that we tend to mix up monetary and fiscal policy, right? So we have this false separation between the Fed and the Treasury because of the political independence angle that we like to tout. But at the end of the day, the Fed, by setting interest rate policy, is actually driving fiscal policy. If the Fed raises interest rates, that results in an increased disgorgement of U.S. national income into the holders of those treasuries, right? So it increases the income that flows into the private sector and into the foreign sector where they're holding treasuries as well, right? So it drives a fiscal impulse. It just goes to a different group, right?
We've even seen this a little bit with the facility, because the corporate bonds are not being bought by the Fed. They're being bought they're owned by the taxpayer, financed by the Fed. Is that monetary support of the corporate bond market, or is it fiscal support of the bond market?
I completely agree. I think this is one of the false dichotomies that people tend to enter into. This difference between fiscal and monetary is really just a choice of who do you distribute the largesse to, right? And part of the story in Japan, I've said this repeatedly, if Japan really wants to drive inflation, they should follow, the arguments effectively of a neo-Fisherian view and increase fiscal expenditures by raising interest rates, right? Now, does that have catastrophic effects on the corporate sector? Yes, right? And so this is the core of the question that I would argue that we're continuing to debate. Or how do we think about the different interests of the corporate sector, the interests of the household sector, the interests of the foreign sector in terms of our trading partners? And we talked about the dynamics of credit vol, rate vol, and equity vol. I think one of the things that a lot of people are very focused on is effectively FX vol, which is the last kind of point, which is if we can't raise interest rates and we need to continually engage in bailouts because we are creating liquidity crises through the destruction of collateral in the manner that we're describing, right? Does it all ultimately have to go to the dollar? Does it have to go to the dollar to create the for Bitcoin?
Yeah, well, I think the classic one, I think you and I gold. I think that's an argument for gold. Going into the Bitcoin question, I do not claim to be an expert on Bitcoin. I don't. I have some opinions. I've been playing with Bitcoin. I've been having a lot of fun with it. Because not in my fun, I think that would go against our mandate, but just personally. Right now, I look at Bitcoin as probably the ultimate speculative vehicle. As someone who was a young mid-20s kid playing VIX curves back when no one was, I've, it's taken, which was such an extremely volatile instrument. It's kind of been fun to trade Bitcoin futures a little bit on the side. Bitcoin trends in a way that we haven't seen assets trend since the 1970s.
Yeah.
I mean, truly dumb turtle trader. I don't want to call turtle trader strategies dumb. I'm sorry to say that.
I understand what you mean. Yes.
But I would say strategies were sophisticated back in the 80s, but are maybe no longer sophisticated today. Work on Bitcoin, which is, I find funny. And it'll probably work until they don't work.
I agree with that.
So it's been fun in that sense. Now, the question at the end of the day is, will it become this new global reserve currency, and will it replace the dollar and all this other stuff? I don't claim to know. I did listen to your debate, which I thought was very, very interesting. I don't believe in the argument that just because everyone else is doing something makes it valid. I don't think that's ever been a good argument. It's never been a good argument in markets. So I think groupthink is a very dangerous thing. So that being said, though, it is interesting. I say to myself, why have they allowed it? This has been the question I've never understood. Someone who doesn't really understand in depth the asset class. Why does the U.S. government allow this to happen? Why do most governments allow this to happen? Why aren't they controlling and regulating it? How is it possible that there can be these conduits like Tether that allow massive leveraging using offshore banks that allow for massive leveraging of Bitcoin and other crypto, and that it's not regulated or controlled? And some people would sit back and say, well, software can't be controlled. You can't control it. Well, I completely disagree with that argument, because I've been to China, and China has one of the most expansive internet growth sectors of any country, and yet you go to China and according to the internet in China, the Tiananmen Square massacre never occurred. So you can regulate software. It happens. So based on that, so why is it being allowed?
So, okay, now this is some area that I maybe know a little bit more about, cryptocurrency. There's several things that I'll say about this. So I guess like the segue into this is, given all of these systemic problems, how do we know that the dollar is safe? Why can't people fly to other assets for safety instead of the US dollar? For example, gold is something when in times of economic turmoil, gold typically goes up, and potentially now there's some new competitors on the horizon like Bitcoin. Why can't Bitcoin or possibly other cryptocurrencies, why can't they come in and basically just completely outcompete the dollar? And in a lot of ways, something like Bitcoin theoretically is a much, I don't want to say safer than the dollar, but when we're talking about, and this was a very interesting discussion, I didn't want to get caught in the weeds on this, but basically what Mike Green was saying is that the monetary policy and fiscal policy are very deeply linked, and the Federal Reserve has the ability to force the hand of the Treasury, because they can manipulate interest rates in a way that drive the behavior of the fiscal policy. And this is a really, I'd say, bad thing. And the independence of the Fed is a bad thing. It's just a bad thing. I mean, if you kind of think about it, it's giving some group of people the power to a large amount of power to manipulate the economy. And there's kind of like this argument like, oh, the government shouldn't be doing this, and so that's why we have an independent Federal Reserve. But at the end of the day, that's almost like concern trolling. Like, oh, what if the government messes up the money supply? They've been known to do that. So let's create a private organization that is not elected and has its own autonomy from the government to control the money supply. That's just giving some other group a bunch of free money and a bunch of power. That's not actually fixing the problem. The problem is that it can be manipulated. And I think it would be better if it was something that was more political, because at least there would be some semblance of accountability. And yes, technically speaking, the Congress can exert authority over the Fed. The president can nominate people. Like, there is oversight. I'm not saying that there's no oversight, but I think experience has shown at this point that this sort of congressional oversight is very ineffective at reeling in rogue organizations. Like, just look at the types of things that the FBI and CIA have done, and how the Congress has just been completely unable to create any structural change based off of these scandals. I mean, there are some things that they've done, but it's been minuscule. And like, for example, the Department of Defense has trillions of dollars missing. Congress has done nothing about this. There's just time and time again, congressional oversight doesn't work. And I think there's a lot of reasons for this, but there's a lot of public choice theory that we could talk about to show why an individual congressman does not have a lot of pressure to actually hold people in these organizations accountable, whereas the people in the organizations, like let's take the Fed as an example, the bankers in the Fed and the bankers that benefit from the Fed have a huge interest in maintaining the status quo, and they're extremely powerful because they control the levers of money. I mean, they're controlling the money supply. So essentially, Congress people are initiated into a group that indirectly benefits from the control of the money supply, and they're put pressure on these groups that are extremely powerful, extremely motivated, and have a huge interest in maintaining the status quo. And that's why there's just no supervision. I think ideally we have something like Bitcoin or something like gold that puts restrictions on what can be done with the money supply. I think it's a nuanced topic. I'm not going to claim to have a bulletproof economic argument. But what I do also like is this idea of just having elected people in charge of the Federal Reserve that can't agree on anything, and it's just like a clusterfuck. That would be pretty cool. Or bureaucrats who just are completely incompetent, inept, and just don't do anything. And if we had a system that was less functional, then we would do less stupid things with it. And of course, there's a balance. You don't want a completely inept system, but most likely, like Congress, for example, do they pass meaningful legislation? No, they don't. They don't do shit. They suck. Everyone hates Congress. But they're also not that bad because they just don't do anything. The problem is a group like the Fed, which is literally a private group of banks that come together and govern this organization. And I mean, we don't even know actually how much authority the Fed chair actually has. Like, I think there's a lot of secretive stuff, and it's just at the end of the day, that's bullshit. Why is it secretive? There's no reason for this organization to be secretive. There's no reason for this organization to have independence. That sounds better for them than it is for anybody else. Oh yeah, you're independent. That's cool for them. Why should people want this? But anyway, not to go on this whole rant about the Fed. Let's talk about Bitcoin. Time and time again. Now this aired in 2021, and so this was a different era in terms of crypto. I mean, it's still roughly the same era, but it was a different era. Things were going up a lot, I think, at this time, 2021. Maybe not, but I mean, crypto has been up a lot for a long time now. And now Bitcoin is like 100,000, so it's gone up a lot since then. I don't know when this is relative to El Salvador's adoption of Bitcoin as a national currency. There's been a lot of adoption. There's been a lot of progress. Crypto itself has evolved a lot. There's been we've rooted out a lot of scams. It's gotten a lot more legitimate. Coinbase has gone public. There's been a lot of milestones, but one of the things that I think is the most notable of a milestone for the crypto industry is the political victory in 2024. And so that includes Trump winning, and that includes basically there is this organization. What was it called? Was it called Stand with Crypto or something? I can look at this. I'll look this up. Stand with Crypto. I think that's what it was called. Yeah. I'm just gonna switch over to this view and pull up this thing, Stand with Crypto. So Stand with Crypto showed a list of all of these candidates, and anyone who has taken a stance on crypto, they've rated them, and they've shown how they've given an A would be a very good pro crypto candidate, and an F would be a super anti crypto candidate. And so if you I wonder if they still have this page up about the 2024 elections. I don't see a, let me just look here really quick. Past events, this is like in-person events. Okay, I don't have, I don't have this chart that I was necessarily trying to pull up here, but the point is that out of this group, most people who, one, were strongly supportive, the more supportive crypto candidate commonly beat out the less supportive one. So one major example is there is a very well-known, well-respected, progressive politician named Sherrod Brown. I don't even know if that's a man or a woman. What's a weird name? Sherrod Brown. Okay, not even there. I guess he or she or whatever they were removed because they're no longer in power. But they got beaten out by Bernie Moreno. Wow, this is so lame. I'm not even coming up with anything. Let's see. Oh, there we go, Moreno. Here we go. Okay, this guy beat Sherrod Brown. Let's see if it gives any context. No context. It's fine. Just believe me. I promise you it's true. Sherrod Brown, see. But it wasn't just this. This was a senator from Ohio. This is huge. Ohio is a swing state. And this is a senator, which is a very powerful position. So this was a huge landmark race, and Moreno is super pro crypto, and Brown was super anti crypto, like as bad as Elizabeth Warren. And this was not just here, but it was across the nation. It was just a landslide against anti crypto candidates. The only person who did well was Elizabeth Warren. Predictably not get beat because Elizabeth Warren is a senior nationally popular senator, and who's deeply entrenched and is on all these important committees, and there's no one's going to unseat her for the time being. But otherwise, it's just been horrible for anti-crypto candidates, and I think there's two reasons for this. I don't want to make this a bigger thing than it actually is. Part of it, I think, is just that the pro-crypto candidates they have their finger on the pulse, and they know that a lot of people like crypto. It's not that people gave them support because they were pro-crypto and they were against people because they were anti-crypto. It's that the people who understood what the common man thinks just happen to then side with crypto because most people like crypto. Or at least, maybe they're just smarter and they understand the potential of the technology. There's something along those lines that I think you can argue pretty strongly. But there is also this element of the crypto lobby, and crypto gave a ton of donations to a lot of political action committees and individual candidates, and it's a very passionate group. And in a sense, everyone in crypto has all of this exposure to the crypto markets, and it's like their life to some extent is wrapped up in the success of this asset class. So if you destroy Tether, or you destroy Bitcoin, or you destroy anything, you go after crypto, you are fucking over a huge group of highly motivated people, passionate people, and they're going to be pissed off. And at the end of the day, nobody really cares. There's nobody loses when crypto goes up. It doesn't hurt people. There's like a few people maybe in Wall Street, they feel like it's kind of a threat, but it's not. I mean, it is and it's not. Like it's vaguely a threat. It's not going to affect anybody, but you're going to have this super loud minority, and it's not even a small minority. It's a big, substantial minority of people who, and like I'm talking about like my barber, like literally multiple barbers own crypto that I've had, I talk to them, they just put some money in crypto because they want it to go up. And they like it, they think it's cool, it's just fun, but they're exposed to it. And so if it goes down, they'll be pissed. If it goes up, they'll be happy. And so why would you touch it? Why would you go after it? The incentives of this are just something that you cannot touch. It's so stupid. What Elizabeth Warren did, she created this thing called the anti-crypto army. And she announced, I am making an anti-crypto army. And it's such a stupid thing to do. First of all, she's supposed to be against Wall Street corruption and overreach. And she's supposed to be for working people and all of that, anti-Wall Street. She's on the financial oversight committee or whatever you call that. She does all this stuff. She talks a big game, talks about holding Wall Street accountable. But then she's basically the thing that challenges Wall Street the most. She's going and trying to take it down, and she's playing dirty. I mean, this is so stupid. She's burned so much credibility. She's hurt herself so much. I know lots of liberals who are upset with her because of her stance on crypto. And so it's just a losing argument. People need to give up on fighting it. It will grow, and there's really nothing that you can do about it. It's not like you can't attack it politically because people's net worth is tied up in it, and they're going to be very passionate and very angry, and people are ready to point fingers. And so it's just most likely that's why it's been let to continue, even if it is a threat to the system. First of all, it's not really a threat to the general system. It's a threat to entrenched interests in the system. But the amount to which it is a threat is marginally less than the amount to which a huge, powerful coalition is bought into it. And so it's just, I don't ever see a scenario in which it's a worthy target. The only time that they can go after it would be at a moment in which it is down a lot and everyone just feels like they've lost. But the problem is that it's unlikely to be down so much that going after it doesn't make it worse. And so it's like you go in, you crash it, it crashes maybe because there was some scam or some sort of scandal, and then you go in and then you make it crash even more. Like, think about all the value destruction that was incurred by the FTX case. Like, how much did the lawyers take from that pot of money that now the creditors are not going to get back in bankruptcy? There's a bunch of things like this where basically, I mean, this has been horrible for the people involved. All the investigators, regulators, the law firm, it's really hurt their reputation with certain groups. And maybe it doesn't matter to some of them, but to certain political groups, it's a delicate balance. And to have people pissed off at you, like the way that unions get pissed off when they lose their job or they lose, some benefits or something, it's very dangerous, and it's just evolving, and our economy is getting more and more and more wrapped up in crypto. And so it's going to be harder and harder and harder to disentangle. So it is a winning bet. I'm not saying this is not financial advice, but crypto as a movement is a winning bet. There's just, at this point, I don't see how you put the genie back in the bottle. And at the end of all that, you try to crush it. You try to do all that. You try to go against these incentives. You stand up. You're like some brave, leader who's a strong person and wants to do what's right, but you're actually retarded, and you try to save Wall Street. Let's say that person exists. Okay, you push against it. Well, guess what? There's also really good civil rights defenses for what people should be able to do in terms of having privacy, they should be able to run on their computer, the fact that people should have the ability to verify state of the software that they use, all this type of free speech stuff, open source, all these things that you're then fighting against all these civil rights that people have. And it's just, you're gonna lose, and you're gonna be embarrassed, and people are gonna hate you. Like, look at the hate that Gary Gensler is getting as he's exiting. He's absolutely ashamed. There are gonna be people for the rest of his life, if he's involved, if he speaks at a conference, if he gets hired by somewhere, they're gonna be like, fuck you, fuck this firm, fuck everyone associated, fuck this guy. And it's just, they're gonna hate him, and maybe they'll forget, but they don't even, forget about people like, there's like this thing, there's like this hedge fund, or what, I don't even know what it was, like a hedge fund, I guess, Three Arrows Capital. These guys and whatever, they were like sort of famous in crypto circles, and they went insolvent. And I don't even know why people are mad at them, but they just felt like they were deceived, even though I don't even think that they accepted like the general public, like retail's funds or anything like that. There's not even a reason, but, and it's been years since these people went insolvent, and people are still like, fuck you, like we hate you. So the point is, like, I've never seen any example ever of somebody who has been forgiven by crypto people. I've never heard of it. I've never heard of it. And I've been in this industry and aware of what's going on since, I don't know, like 2012 or something. It's been over 10 years. And so, like, I've never heard of anyone being forgiven. And in fact, it's like, people should be forgiven. Like, I think Sam Bankman-Fried, like, we should just get over it. He made some mistakes. He was young. Like, I think that was an overreaction. I think all these things are overreactions, but people don't. It is cult-like, and say what you will. You can say that's a bad thing. You can try and frame this in a negative light. What I'm saying, I'm just telling you the facts and the reality of politics. If you want to get things done, don't also do your priorities. Don't try to go against crypto. You're not going to succeed going against crypto. It's a losing argument. And then it's going to sabotage all your other priorities. So unless you only care about ending crypto, which is absolutely stupid, don't touch it. Just side with it. Give in, give up. You're going to lose. You're going to fail. That's just the truth. And that I'm not even getting into what your policy should be. I can give you amazing arguments in favor of crypto. It's about verifying truth. It's about getting to the bottom in an internet where nothing can be trusted. It's about proving things and having some ground to stand on where you can substantiate what actually happened online. This is absolutely essential to fighting disinformation. This is a civil right. I mean, the right to privacy, the right to private communications, all of these things are so important, and crypto enables it. And we're going to get in later episodes, we are going to get into the structural problems with financial markets, which we're touching on here, but we're going to talk about the corruption angle on it. It's not just, oh, it's these markets, there's so much debt, blah, 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 it's just so bad, it's going to crash the economy. That's not the only takeaway from this type of a discussion. There's also specific instances in which people are getting enriched by the system existing in the way that it is, and they don't deserve it. It's a corrupt system. And we're going to, and in later episodes, we're going to dive into this corruption and show how crypto solves this problem and removes the corruption from the system. So it's a very good technology. There are some weird elements to it. There's cult-like behavior. People do speculation. There's scammers that have been involved in the industry in the past. All that is true. But that is just the world we live in today on the internet. It's a volatile world. Anyone can participate. But at the end of the day, there's no gatekeepers. And it's an inclusive place where it ultimately, in the long run, it elevates people across the world who are capable and competent. And it is a meritocracy, and that is going to push humanity forward. So that's what's going to happen. We'll talk about that more in the future. I want to get back to the awesome insights that Mike Green and Chris Cole are discussing.
And I thought about this recently. Bitcoin has the currency in circulation, or the value of Bitcoin, has approximately equaled the currency in circulation of the Japanese yen very recently. That's interesting. We're talking about currency in circulation. We're not talking about M2 or M3. There's different ways to look at money. We're just talking about basic level currency notes in circulation. But that's actually fascinating. I've been thinking about this intellectual thought experiment. I'm interested to get your views on this, because I think you know a lot more about Bitcoin than I do. Let's imagine that, and this is an absurd argument. It's absurd. This would never happen, but I'm just saying, let's imagine this alternate hypothetical reality, that Japan comes out and they say, this yen experiment has been really interesting. But as of July 1st, the Bank of Japan is going to go by the wayside, and we've worked out an agreement with the United States government and hopefully be. Well, that would in effect be like that's of course absurd.
Well, it's not actually. That's exactly what happened in 1947, right? So
yeah, that's true. Actually,
that's happened a lot throughout.
But there was an intervening event that led to that coercive outcome, right? So it's not quite as absurd as you're presenting. But let's continue with the example,
the hypothetical example. So under that circumstance, it would be massively. It would be like a form of tightening of our monetary policy. Everyone from Japan would now be forced to buy U.S. dollars.
Absolutely.
Right? All these carry trades would go by the wayside, right? It would just, everyone would have to jump into the U.S. dollar. It would be a form of monetary tightening to the U.S. dollar.
So let's just break that down for a second. So there's supply and demand. So let's say that the supply stays the same. That means that if demand goes up, the price will go up. So if everyone from Japan is trying to get dollars, meaning they'll be willing to give their real estate or their equity that they hold, any sort of assets towards dollars, that is going to increase the value of the dollar, which would increase the purchasing power of the dollar. That would cause deflation. But also, at the same time, that would be similar to shrinking the money supply. So like, let's say that you can print money and have inflation, which would be like you're buying debt essentially. And by buying debt, you're putting more dollars into circulation. Like if the Fed is buying debt. Well, if the Fed does the opposite, which is to sell the assets on its balance sheet, it will accept dollars as payments for those assets. And as a result, it will be removing dollars from the money supply. And why we say that is because there's dollars in the money supply. And the Fed, when the Fed creates dollars, the Fed can create dollars at any time. And at a logical consequence of that is that when the Fed takes in dollars for any reason whatsoever, that dollar effectively no longer exists because it's no longer in circulation. Yes, the Fed could give that dollar back, but that's the same as essentially creating a dollar. So when the Fed buys debt, they are creating dollars to buy that debt. And then like they never have dollars, basically. You shouldn't think of it that way. They have assets on their balance sheet. So they create dollars to buy, for example, mortgage-backed securities to bail out the industry. So let's just run through this as an example. When there was a housing crisis in 2008, there was all of these mortgage-backed securities, meaning there were mortgages for houses that people would not be able to pay. There was completely bad assumptions around the value of the houses and the eligibility of the borrowers and all of this. So these were horrible, low-quality mortgages. And what happened is there were these financial instruments that bundled a bunch of mortgages and levered them and did all these things. And basically you could invest into the mortgage market. And that mortgage market was overvalued. And what happened is there was a point at which everything collapsed. And that went down in value. So there were these mortgage-backed securities that went down. And this was causing catastrophic losses in the system, in part because there were a lot of assumptions built into these assets being more valuable than they otherwise would. Like, for example, someone might have taken a loan out where this was the collateral of the loan. And now when they had to repay the loan, they couldn't repay the loan and their assets were liquidated and stuff like that. So the point is people thought we have this much value in the system, it's stored in these mortgage-backed securities. Now that value is down. Now we don't have the money we thought we had. And there's a cascade of things. And we've talked about this earlier, especially in the last stream, about all the different types of cascades that can happen when there's these crises. So at that time, the Federal Reserve printed money, and it used that money to buy mortgage-backed securities or mortgages. I'm not sure exactly what it bought. It bought certain bad debt instruments from the private sector, and that would be considered a bailout. Why is it a bailout? Because they were going to lose the value of their investment. Maybe they go insolvent, maybe their portfolio goes way down. They were losing money. And what did the government do? Not the government, but the Federal Reserve. The Federal Reserve gave them the money and just took that asset off their hands. So they said, just trade. I know it's gone down, but just trade. We'll just buy it from you. And so they gave them cash. And that was, in effect, printing money, because that money did not exist. The Federal Reserve doesn't hold money. I mean, it like manages bank balances, but the Federal Reserve, when it gets dollars onto its balance sheet, it's like taking it out of circulation. So it printed money to get these assets on the balance sheet, and now that it created that dollar and bought the asset, that dollar is now in circulation, and the amount of money that is now out there for other people to use is higher. So that's why the money supply is higher. But also now when you do the accounting for the Fed, you see that these assets are on the Fed's balance sheet. So the assets there's like a list of all these securities that they bought when they gave out dollars. They were printing money, and then now they had these assets on the balance sheet. So at that point, when they were buying up debt instruments, this was called quantitative easing, and this was like loose. They call that loose monetary policy. I think it's loose monetary policy. It's stimulatory. They are putting money into the system, cash, and they're buying up bad debt. So money is created. Now, when you tighten, you do the opposite of that. You now can sell those assets. Now they can go and say, hey, we have all these mortgages, who wants them? Or we have all these treasury, who wants them? So they'll sell these and they'll auction them off. And so people can then pay them cash for the assets. That is tightening, because someone has paid cash, and now the Federal Reserve is giving away those mortgages or whatever, those debt instruments that they had acquired on their balance sheet. They're giving them away, and in return, the person is paying them with dollars. But since they created the dollars in the first place, once they get those dollars back, it destroys dollars. So what he's saying is that when Japanese people in this hypothetical scenario would be trying to get dollars, they're essentially increasing the demand without increasing the supply, because the amount of dollars there is the same. And so since they're increasing the demand and the supply is the same, that's in a sense like when the Fed is trying to sell mortgages, because now the Fed is trying to demand dollars. So it doesn't really matter necessarily where the demand comes from. The demand can have the same effect. And so that's equivalent to tightening. So either in this case, Japan is the one demanding the dollars, and in the more traditional tightening sense, the Fed is the one demanding the dollars. In both cases, it has the same effect of increasing the demand for dollars. Okay, let's continue hearing what they have to say.
So the fact that alternative vehicles exist means that in a beggar thy neighbor type of policy, it allows for if there's an alternative store of wealth via another currency, it allows for a transmission of volatility from other currencies or other dominant currencies. Now, the US government, the US dollar is the most strong weapon that we have. Our global aircraft carriers exist to support the dollar infrastructure. I do not believe that the US government is to overnight allow dollar dominance to evaporate. And I think it's highly naive to imagine that it would. But if you were going to create some sort of, in a dynamic where you need to in essence, where you need to have an expansive, unprecedented monetary policy, and you want that expanded monetary policy supporting liquidity for capital markets to function in a way that doesn't result in excessive speculation, where house prices in Austin are worth $5 million. In that sense, most people are thinking that Bitcoin is an antagonist to the Fed.
Mm-hmm.
I would actually argue at this juncture, it may actually be helping our monetary policy and the smoothing of liquidity, transmuting asset price volatility from asset class into something that is right now a purely speculative.
That is very interesting. So I think what he is, that's very interesting. There's maybe several angles to what he's saying. One is that, in a sense, Bitcoin is like the opposite of the Japan scenario, where you can, it's like almost like a loosening of US monetary policy instead of a tightening, because people are now fleeing from, instead of fleeing to the dollar, they're fleeing from the dollar. So it's almost like an expansionary monetary policy. And it is interesting how you might say, like, why is it not like another asset expansionary monetary policy? Let's say that mortgages, as an example. Why, like, okay, maybe mortgages, everyone's trying to buy mortgages, then that could be like something that's stimulatory to the economy, because it's like less demand for dollars is like quantitative easing. It's like loosening. Now it's like the money supply is basically being expanded because there's less people wanting dollars, and instead they want mortgage-backed securities. You might say that that is true, and that there might be some truth to that. But here's the issue. That distorts what people are doing in the real world. So now people are actually using houses differently. Like, people are moving who shouldn't be living in certain houses are now moving into these houses, and it creates all this distortion in how people are allocating resources. You can't simply just create a bunch of mortgages, because this is constrained to real estate. On the other hand, though, Bitcoin actually really doesn't. It's purely serves like a monetary function, where it doesn't actually like matter about any sort of underlying asset allocation, in terms of what, like, the value doesn't affect asset allocation. It affects the exchange rate, but it doesn't actually drive behavior. When the price moves, it doesn't cause a market to reallocate. It doesn't cause, like, aside from trading, internally, it doesn't actually reallocate resources. So there's a less distortive effect of using Bitcoin for quantitative stimulus and easing. It causes less demand for dollars. That is basically like loose monetary policy, and in a sense it stimulates the economy if you assume that's how things work. That's an interesting point. I think that's the kind of point he's making. There's also some sense in which maybe speculators are drawn to Bitcoin as opposed to real estate. It's something more pure, easier about it. It's pure speculation. It may like reduce some negative speculative activity that occurs in the housing market. I have a hard time even painting speculation as negative in the first place in the housing market. I think it's fine to speculate in the housing market, but there may also just be, maybe there's some distortion just from people who want the speculation and don't care about the underlying asset. Like, there are these people out there who think real estate is a way to get rich. People always tell me, got to buy a house, then you move into another house, you take the rent and you pay your mortgage, and you do house hacking, and then you buy another house and you lever up. There's these people who think that this is the way to make money. I think that's not the best way to make money, but it is a very common viewpoint. Now, these people are not actually constructive to the real estate market that much, because they basically are ideologically driven. They just think this is the best way to make money, and they don't actually have any notion of value inside of the real estate market. And so as a result, they end up just basically making bad decisions. And I mean, it's not bad decisions, they still can make money, but they're not like really contributing to market efficiency. Maybe I would posit they're not. And some of them are good, some of them are not, but maybe the worst of those people who do distort the market to some extent are now fleeing to crypto, because crypto provides them a more pure speculatory mechanism there. That could actually help if real estate is the only market you can speculate on, the only way you can do 5x leverage, and you want 5x leverage on some investment, then you're going to just jump into that market and use it for that, but you're not actually like, adding value to the land and like utilizing that properly. You're just holding it. It reduces the inventory, blah, blah, blah. I mean, who knows what you're doing, right? There's dumb people that are misusing real estate out there, thinking that they're going to get rich. Those people can move to crypto. It's also like, it can, make the real estate market more efficient, perhaps. But let's keep watching.
We're able to transmute $1 trillion worth of excess speculation that otherwise would be pumping up real estate prices, causing civil unrest in the United States, pumping up stock prices even more. You're able to transmute that to this asset that really only exists right now for speculation. That only exists for speculation. And maybe that's why they allow it to exist, because it transmutes that political instability out of the monetary volatility into a relatively benign speculative instrument.
Chris Cole has this really interesting quote. I'm going to butcher it here, but I think it's something along the lines of volatility or risk. Is it volatility or risk? Either way, volatility, let's just say volatility cannot be created or destroyed, but it can only be transmuted. Or it cannot be destroyed, but it can only be transmuted. And so he talks about this idea of transmuting volatility quite a bit. And I would love to learn more about this particular train of thought that he has. I don't think that he's explaining it very well here, and I have not heard a very good explanation, but there is something about transmuting volatility from one asset to another, which seems like a very powerful idea to understand. So I'm going to be looking for more of his talking about this subject.
However, the thing that the Bitcoin people want to happen, which is, or expect to happen, that will have this hyperinflation in the US and the Bitcoin would explode, could actually be the thing that causes all of the global reserve currencies and all of the global central banks and all of the national security apparatuses to shut it down and control crypto. Because at that point, it will be in their interest. Just like stagflation's getting out of control, you can tighten monetary policy, $6 trillion taxing it. I mean, taxing it alone, right? You can tighten your monetary policy overnight simply by sticking the national security apparatus on that. And it becomes a way to mitigate the political risk, a relatively basic speculative instrument, and they'll shut it down when they need to shut it down, when it's in their bed.
Yeah, so what he's saying is true, technically true, but realistically, that's not going to happen. By doing that, they're going to screw over so many people who are very passionate, who are very upset. And even if someone loses like $100, like they get very upset about that. It's just a fact. Like, they get so upset, and especially if the whole economy is going down, and then like, it's one thing for crypto to crash. I'm talking about the government takes action and it leads to the crypto crash, and like they put on some huge tax, sells off. Like, people will be so pissed. It's never going to happen. And why do they let it happen? Well, first of all, it's too late. Second of all, they're incompetent. They're completely incompetent. These people, they are barely getting by. The people that are running policy, they're pulled in a million different directions. They have no idea what they're doing. They're stupid. And yeah, they're going to get a lot of pressure from certain people on Wall Street at some point. But you know what? There's people on Wall Street taking both sides of this. And at the end of the day, it's like the average population is long crypto. And I'm not even saying this as someone who invests in crypto. I don't. I have some that I bought a while ago. I hold it. I'm not buying anymore. I'm not selling. I'm just whatever. It's not even an important thing to me at all. But it's just a fact. The population is long crypto, and you're going to crush them, and you're going to piss them off. There's going to be so many passionate people talking about what they did whenever they do that. And then that's going to enrage even the people who have very limited exposure, because they're, of all the people who have very high exposure, complaining. I'm going to let this play, but I'm also going to get up out of my seat and plug in my laptop.
Benefit to show them. I don't know. I don't claim to know. I'm kind of curious as to your thoughts on this.
A quick reaction is that asset inflation replaces, or asset speculation, and then the increase in price of assets absorbs some of the excess liquidity that is created in this required liquidity surge to offset the solvency concerns, right? So it's the easiest way to think about, what the Fed was forced to do in March is that they, faced with the risk of a corporate solvency event and a household solvency event in the runway with tremendous liquidity that turns forms of equity injection, effectively. And some of that, of course, finds its way into spec assets, right? And initially, that removes purchasing activity from the economy, which mitigates some of the inflationary dynamics, exactly as you're describing. One of the concerns that I have around that dynamic, though, is the leverage that exists in the crypto space, particularly in the dynamics of Bitcoin itself is then used as collateral for loans that are in turn used to purchase Lamborghinis or additional speculation in Bitcoin itself, right? That creates the conditions under which you could see rapid changes in net worth for individuals that has deflationary characteristics and would require the Fed to, again, foam the runway, right? So I would argue that the crypto or Bitcoin world is in this weird place where they simultaneously castigate the Fed, and yet there is an embedded Fed put that should things go really badly, the Fed is then going to respond to the collapse of $1.6 trillion asset class. My concerns around Bitcoin are more along the lines of what you're saying. First of all, I think that it is ultimately a bad analysis of game theory to think that the U.S. government is going to adopt Bitcoin, right? It is not, I cannot, knowing the U.S. government and knowing the dynamics, I cannot see them forfeiting that right and rewarding this type of speculation.
Yeah, I do agree with this, and I'm actually opposed to a, what do they call it, a strategic Bitcoin reserve. I don't think that's necessary. Perhaps the U.S. government can hold on to the Bitcoin that it already has seized and stuff, but I don't even like them seizing things in general, so I don't care what they do with that. It's not that, like, I mean, I would prefer that they just, like, it's kind of sketchy that people aren't even able to seize things in the first place. I mean, I don't know, it's a nuanced topic, but they should not be buying Bitcoin. The U.S. government should not, because what that is what you don't realize. You think you own some Bitcoin and you're in this group, and maybe you would benefit from it, but you're not in this group. There are people who bought Bitcoin early. And look, okay, I think it's a good time to jump in here and say, there is I want this to be like a comedy show. Like I talk about serious things, but sometimes I just like joking around and doing bits. And ideally, I aspire to make this more comedy and less seriousness. I mean, it's always going to be serious, but like just putting in that jest, you know? So I was going to say this, it's a joke, but like the people who bought Bitcoin are so stupid. The early people, if you talk to them, they're like, they are like just stoners who got lucky and they just basically haven't done anything for a decade. And and there's these people, and even the ones who are not like that, like they are not so amazing that they necessarily deserve the to be like come infinitely wealthy. Like they're not Elon Musk. They are mid-tier. There's a lot of midwit takes. And in fact, if you go back and you listen to what economists were saying that learned about Bitcoin in the early years, they were all talking shit. And these are smart people. These are very smart, educated, high IQ economists. And they were saying that Bitcoin wouldn't work. A lot of people thought it wouldn't work. And that you had to kind of be stupid to think that it would, because it was super unlikely. And so there's a lot of people who basically do not deserve it. They don't work that hard. They're not that competent. They were just, a lot of people were just buying drugs on the dark web, just being like whatever, just like losers, but they happen to have Bitcoin. And then there's people who like maybe were able to buy a huge size of Bitcoin by managing a very low amount of money, and it wasn't hard to do that. So they really just got lucky. It was a lot of people who got lucky. And what they hold so much of the total supply of Bitcoin. Like you think you own some just because you're on Coinbase and you bought some or whatever. You don't. Like that's nothing. Okay. And then there's these ICO, like some just like absolute losers from some shithole country that doesn't have securities laws and doesn't, like they're just desperate to make some money. They've done like these big ICO scams back in like 2017, and they just have some stupid idea that hasn't done anything for anyone. And now these losers in shithole countries now hold a ton of Bitcoin because they use Bitcoin or ETH as like the funding vehicle for the ICO, right? So many examples of this. So it's like, who's holding the Bitcoin? There's some people who definitely deserve some profit from their investment. And overall, these people, I like a lot of these people. They're very nice, but we don't need to bail them out. They're doing just fine. Let's not pump their bags. This is not your bags. You barely have any Bitcoin. Let's be honest. You don't. You don't have shit. And you should not even be thinking about investing because you probably have so little money that doesn't matter. And if anyone is like inheriting money from a billionaire here or something, and you're weird, it cut out. I wonder what happened with the YouTube. Sorry, everybody, for the technical difficulties here. I guess my camera's down. Okay, everybody. Well, I'm sorry about this technical issue. I'm just going to end this stream because it's already been a good amount of time. And yeah, we'll continue tomorrow and finish off this video. Thank you so much for tuning in. And if you enjoyed this and you like my jokes and you like my commentary, please subscribe. I'm going to do a lot of intellectually stimulating, entertaining content that introduces you to ideas, that helps you think, and is bullshit free and won't waste your time. I want something that you can just enjoy while learning, listening to. Please subscribe, please like, please comment. Thank you.